Hello, in this video we'll talk about installment sales. Now this is meant to be a basic discussion. This is one of my favorite topics because it really ties together all the different concepts in the previous videos that deal with property transactions and characterization of gains and losses. It really focuses on property transactions, calculating realized, recognized gain or loss, non-recognition rules, adjusted basis and whatnot. But at the same time, it's really important to understand that characterization is an important element. I'm going to talk briefly about that at the end and how it can be very complex. Now we're really going to focus on the side of the seller. I'll mention the buyer at the end, but it's really important to focus on the seller because the seller is really the real challenge is calculating the tax consequences for the seller. So before we go into the rules of the installment method, let's consider an example. Let's say you sell a building. Doesn't matter whether the building is a business building, an investment building, or even maybe your personal home. It's still a building. And you sell it, and you're going to sell it for a gain because the adjusted basis is $60. Well, you have two possibilities from the buyer. The buyer gives you two possibilities. The buyer says, okay, at closing, I'll pay you $100. Or the buyer says, I'll pay you $40 at closing, $40 next year, which is year 2, and then additional $40 in year 3. For a total, if we add up all of those numbers, we get $120 paid over those 3 years. So you can have $100 today or $120 over the entire 3 years in total. Well, if we calculate the tax consequences and we picked alternative A, we sold it for $100 today. It'd be real simple. If we go back to our previous realized gain, recognized gain or loss, and we're assuming we're selling. So this would be our amount realized. The $100 would be our amount realized in the year of sale, minus the $60 adjusted basis. That would give us a $40 realized gain that would be recognized. Because if we're selling for cash, there's really no non-recognition rule that we would have. So we'd recognize that $40 gain, and the character is depending on whether it's a personal house, a business building, or investment, and how long it's held. But we'll just, for the purposes of this, assume it's a $40. We're not going to worry about character, but it's a $40 gain, and that's going to be recognized in the year that this is sold and upon closing. However, if we do the alternative B where we get $40, $40, and $40, the question becomes, how do we recover the $60 basis? We have a bunch of different possibilities. We can use up all $60 in the first and second year. Or we can do the $60 adjusted basis at the end, so in years 2 or 3. Those are really the options, and that's really an ordering issue. The order issue is how exactly, if you consider the timing, well, when is that $60 a basis going to be used up? Well, there's a few things to consider. The first is that we need to understand that if you are a seller, you want to defer gain as long as possible, and that's generally speaking, because time value of money. If you don't have to pay taxes until the future, then you get to save that money that you could use to invest in other ventures today and then pay it off in the future. So you can invest that money you would have to pay in taxes today, which you can just pay off in the future because the numbers don't necessarily change. Okay, so it's all about ordering. So if we are a seller, we prefer that approach, right? We would prefer to use all $60 in year 1 and 2, and then whatever is left out in year 2 and year 3 is just going to be gain, if we could do that. So that's the first thing to consider, right? First thing. So that's, if we were able to do that, again, use all $60 up front in years 1 and 2, that would be a taxpayer-friendly rule, if that is the rule. We'll talk about what the actual rule is in a moment, but that would be a taxpayer-friendly rule if we could do that. Now again, if we did it all at the end, so it would be year 2 and year 3, well, that would be not taxpayer-friendly. Because again, in general, the seller would prefer to defer gain as long as possible, all the way to year 3 or year 2, and not recognize any gain in year 1 if possible. So that's not taxpayer-friendly. Now, another thing we need to consider, in addition to time value of money, is that this $120, right? There was $100 if we do in year 1, but it's $120 total in year 1, 2, and 3. What really is that $120? Well, $100 of that is really what we consider principal, right? Principal, which by principal we mean it's the $100 that the buyer would pay in year 1. The other 20 of that is really interest. It's like the seller is giving a loan to the buyer, but the buyer has to pay interest and principal over time. So that $20 is interest. So really, we can't actually just use up the basis on all of this up front. We have to separate out the interest. Now let's assume for simplicity that in year 1, the amount of interest of this $40, $7 of it is actually interest. So $7 of the 40 is interest, which means that the remaining 33, right? 40 minus 7 is 33, is considered principal. In year 2, 7 is interest. And in year 3, we have $6 of interest. So if we add up all the interest, we would get 20. 7 plus 7 plus 6 is 20. If we add up all the principal portion, right? 40 minus 7 is 33 for year 1 and 2. So 33 plus 33 is 66. And then 40 minus 6 is 34. 66 plus 34 is 100. So we have to break that up because it's important for characterization purposes, because under our tax law, interest is always treated as ordinary. If you're selling this building and it's 1231 or long-term capital gain or short-term capital gain, ordinary is different from short-term capital gain or long-term capital gain or 1231. If you don't understand that, see our previous videos. So we do have to break that up, and that's very, very, very important. And it's going to be even more important when we talk later on about the characterization aspects that make installment sales very challenging, and I'll mention that. So it's important to understand economically that when you have a payment, multiple payments over time rather than just one lump sum payment, portion of that payment, there has to be some type of interest component, or else why would you defer your money? You could use that money, get all 100 up front and start investing that and make some money off it rather than wait. Think about it. If you are the seller, you wouldn't do $33, $33, and $34 in years 1, 2, and 3. You wouldn't do that. You would just take all 100 up front, right? If your options were do $100 in year 1 or 33, 33, 34, you would obviously do the 100. But you might do 40, 40, and 40 because you get a portion of it as interest. And that might be a good interest rate. You're getting a 20% interest rate if you think about it in total, because 100 principal, $20 interest, that's 20% interest. That's pretty good. Okay, that's a pretty good interest rate. So there's a little bit of a icing on the cake to incentivize someone to defer, because a lot of buyers, especially if you're talking about millions of dollars, they might not be able to get all the money up front. So that's very important to understand, okay? So let's go back to our possibilities. Again, if we were allowed to use the adjusted basis up front, it would be taxpayer friendly. If we did it at the end, so we came in, we rear-ended it, then it would be not taxpayer friendly. So really what the rule is it's somewhere in the middle. The actual rule, what we have, and we're going to talk about the actual rule and how we apply it, is a middle approach. It's a rateable apportion. It is a rateable apportion. That's the installment method that we're going to talk about. And really what it is, this is a partial non-recognition rule. So we talked about non-recognition rules in general. We talked about like-kind exchanges, involuntary conversions. This is really going to be a partial non-recognition rule because it's going to defer part of the gain. What do I mean? Well, if we had this situation, we would have all 40 gain in year 1. But we're going to see under the analysis that only a portion of the gain in year 1, you're not going to have all 40 gain, you're going to have a smaller portion, because you're going to see that we're going to be able to use some of the basis in year 1, some of the basis in year 2, and some of the basis in year 3. So we get to defer gain over that period of time, which if you are the seller, that's good because we don't have to pay all 40 gain up front. Now you're going to be recording interest at ordinary rates, so that's going to give you a negative tax consequence, but at least you're getting interest from an economic standpoint. Now, if you think about it from a tax policy standpoint, and we talk about non-recognition, this has to do with this method of doing a rateable approach rather than doing the ordering of all basis up front or all basis at the end. Really has to do with efficiency. If you recall, in tax policy, there's 3 major elements of tax policy. There's simplicity, which deals with how simple is the tax system from both the IRS's perspective and the taxpayer's perspective. There's equity or fairness. How fair is a tax when you compare it to different types of taxpayers? Efficiency is all about economics. Well, if you think about it, if somebody is receiving principal payments over time, it makes sense from an economical perspective that maybe we should also ratably adjust that basis over time as well, because that basis is a recovery of capital, and it pertains to those payments over the time, right? It's obviously easy if it's all in the same tax year. That basis relates to that property. But think about it like you're selling one third of the building. You're selling a third of it, a third of the building over time. Well, then you need to obviously do a third of the basis, if you will, and that might be how we actually rate it out. But I'll give you the actual formula later on. Now you're transferring to the buyer all the rights of the building, but from an economic perspective, again, when you look at it on paper, it might be viewed as a third in a way. And that's generally how the tax law looks at it. And that, from an economic perspective, makes sense. Okay, so that's really the policy behind it and the issue and the possibilities. And that will really help you understand. Again, make sure you know that we have to separate out the interest and principal, and know that with every payment, what portion of it is interest and what portion is principal as well. It's very important. So when does this installment method apply? Well, the first thing that we need to know is that in order for there to be an installment method, you have to have a gain. You have to have a gain. The installment method will never apply to a loss. And why would you want it to apply to a loss? You'd rather recognize the loss all up front. So if we had the same situation, let's say the adjusted basis was 60 and you sold the building for 40. Okay, and over time, let's say you got $50 over the 3 years. Well, that would be a $10 loss, if you will, right? If you sold it for 40 or you got 50 with the installment method, right? The installment payments over the 3 years. Well, you would have a loss in either situation, right? You'd have a loss in A or B, situations A or B. You'd rather just take the full loss in the first year, and that's how the law treats it. The installment method only applies to gains. It only applies to gains. So the other requirement, and we have to have both of these, is that we have 2 or more tax years. This is very important. Tax years with payments. And we'll talk about what a payment is when we get to the basic formula, but we have to have 2 or more tax years with payments. So the idea is that if all the payments are made in the same tax year, you can't apply the installment method because all the basis would just go to that. You would just add up all the payments. But once you have a payment that goes beyond 1 tax year, so let's say you only get one, if based on your agreement, you only get 1 payment in a year, you have to have at least 2 tax years. But you can have 2 or more. Here in our example, we had 3 years, and we had a payment in each year, 1 payment in each year. So we have to have 2 or more tax years with payments. 2 or more tax years with payments, not 2 or more tax payments. We have to have 2 or more tax years. Very important. It has to involve 2 or more tax years, and you're getting payments over those 2 or more tax years. Okay, so let's go right into the basic formula of how we apply the installment method to the gain. Again, we have to have a gain, and it has to be involving 2 or more tax years with payments. So the first element of the basic formula is we're going to take the GPR. The GPR. GPR means gross profit ratio. The gross profit ratio times the payments. This is payments, not payment, because you're going to add up all payments in a specific year. Payments in the tax year. In the tax year. So it's the gross profit ratio times the payments in the tax year, and that will equal the gain recognized for the tax year. So again, it's the gross profit ratio, the GPR, times the payments in a tax year. So you add up all the payments in a specific tax year, and that will give you the gain recognized for the tax year. Okay, so let's talk about what exactly the gross profit ratio is, or the GPR. So the GPR is a ratio. It's called a gross profit ratio for a reason. The gross profit ratio is the gross profit over the contract price. And I'm going to define these terms. The gross profit over the contract price, and that gives us our gross profit ratio. So first thing is the gross profit is the selling price, and I'm going to define this later on. The selling price minus the adjusted basis of the property being sold. The adjusted basis, which the adjusted basis includes any selling expenses. So we include any selling expenses. So selling expenses related to a building might be like real property, real estate fees or whatnot, or surveyor fees, surveying the property and whatnot, stuff like that. So including any selling expenses. The contract price also starts off by the selling price, but we subtract away something else. We subtract away any qualifying indebtedness. Qualifying indebtedness. I'm going to define this. We know what adjusted basis is from our previous videos. If you don't remember that, please watch the previous videos. It talks about adjusted basis and how we calculate that. But qualifying indebtedness is something we have to define, which is also known as QI. Now this is to the extent of the adjusted basis, including any selling expenses. So the idea here is you subtract away the qualifying indebtedness, but if the adjusted basis is less than the qualifying indebtedness, which we'll talk about qualifying indebtedness, you stop at the adjusted basis. And you'll see what happens to the excess later on. It's basically going to go into the payment. The excess, if there's any, goes into the payment amount. So what is selling price? So selling price is the gross sales price, not including two things. So it does not include two things. Not including. So we take them out of the gross sales price. Okay? So the first element that we take out, or it's not part of the selling price, so it's a gross selling price not including the liability that's on the property. So if you are the seller and you're selling some property that has a mortgage on it, the building has a mortgage, let's say, and the buyer takes, assumes or takes subject to the liability, it's not part of the gross selling price. We take that out. We usually with amount realized we add that back, we add that in, but we don't do it here. So liability on the property, encumbered on the property. Or we do not include in the gross selling price any interest or original issue discount, which is known as OID. Original issue discount, OID. And I'll talk about original issue discount at the end. It's one of the topics I'm going to mention. But for right now, think of OID like interest. Very similar idea. It's like accrued interest, if you will. It's like accrued interest. And we'll talk about OID specifically later on. So remember above in our example, we had to break out the interest. This is one of the main reasons. Part of this formula, the selling price, does not include any interest. So it only includes that principal portion. That $33 in year one, that $33 in year two, and that $34 in year three. See how that works? We have to take out the $7, the $7, and the $6 interest payments during those respective years. OID, think of it like interest when it's accrued, like it's not in there, it's not specified. And we'll talk about that. Now, what about qualifying indebtedness or QI? So we're talking about indebtedness, we're really talking about liabilities. And there's really two major liabilities that make up qualifying indebtedness, normal qualifying indebtedness. The first is a liability on a property. So again, we had a liability on a property here. It's not part of the gross sales price, and guess what? It gets subtracted away. So if it's a liability on a property, so see in my discussion we just talked about, right? If the property is encumbered by a mortgage or a liability, for example, the building has a mortgage on it that the buyer takes subject to, right? That's a liability on the property. Or another type of qualifying indebtedness is that deals with another liability is a liability not on the property, but taken on by the buyer. That's as a result of this transaction. So maybe the buyer borrows some money from a bank to finance this, okay? Well, from the buyer's perspective, that doesn't affect the seller, right? That doesn't affect the seller. But there could be a liability on the other side that is not on the property, but it deals with the actual transaction that the seller has to pay off or something like that. That gets subtracted out. So as a result of the transaction. But really what you're going to see is a liability on the property. Liabilities not on the property can happen, but they're not as common. So it's a liability not on the property, but taken on by the buyer as a result of this transaction. So maybe it's not on the property, but maybe the seller had some type of financing agreement where they say, oh, as part of the proceeds, it's not on the property, but you're going to assume this liability as some type of constructive proceeds, if you will, some type of constructive proceeds. Okay. So we've talked about gross profit ratio. Again, gross profit ratio is the gross profit over the contract price. We define gross profit and the contract price. We define selling price and qualifying indebtedness. We know what adjusted basis is based on our previous videos. So now we have to talk about payments in the tax year. So we're really just going to refer to it as payments because I'm assuming that you can understand in the tax year applies to a specific year. So payments really have three components. There's really three components that make up payments. There's really three different types of payments. The first type of payment is the principal portion. So we're talking about the principal, right? Again, you subtract away the interest. The principal portion of the payment. So again, when we look at our example, our alternative B, we're talking about in year 1, 40 minus 7 is $33. That's the principal portion of that payment, right? The principal portion of a payment actually or constructively received. So this is not interest or OID. The second item that's considered a payment is the buyer's assumption of debt that is not QI. So if it's not considered QI, qualifying indebtedness, which we defined earlier, it goes under here as a payment. Buyers, so if you have some type of liability, it's not related to the transaction. Buyer's assumption of debt that is not QI. And this is, again, quite rare when you don't have a buyer. Usually when the buyer assumes a liability, it's usually on the property. That's usually the most common. So it's the buyer's assumption of debt that is not QI. So that's, if there's anything that's not QI, it goes there. The third, remember we referred to the contract price as the selling price minus the qualifying indebtedness, but it's only to the extent of the adjusted basis that we determined in the gross profit calculation. Well, if you have an excess, if you have the qualifying indebtedness that's over the adjusted basis, it's gonna be considered a payment. So this is the buyer's assumption of QI, the excess QI. Buyer's assumption of excess QI over the adjusted basis. So that excess amount that we had up here of the contract price, right, this qualifying indebtedness portion, you're limited to the adjusted basis. Anything that's in excess goes down here as part of the payment amount. So that's how we calculate payment. So we got our gross profit ratio and we got our payment. We multiply those two together and we get our gain recognized for the tax year. Now, I'm going through a lot of, if you have liabilities and stuff, you might have a very basic example. I want to talk about some additional issues. I mentioned we would talk about OID. So let's talk about interest and original issue discount. So we know what interest is. And interest is recorded in the year it's received. OID, original issue discount, the best way to think about original issue discount is think of a junk bond or a bond that a zero coupon bond is a better way to think about it. I say junk bond, a zero coupon bond. Basically, a zero coupon bond is there's no interest that is paid during the life of the bond. You buy the bond at a certain amount. Let's say you pay $50 for the bond, and in 10 years, you get $100. Well, the $50 that you paid is considered the principal. The other $50 that you get at the end, in addition to the $50 of principal, is considered interest. So OID, really what it is under the tax law, OID makes sure that the taxpayer has to record interest ratably over time under the default rules of OID, original issue discount. Okay, so that $50 of interest I mentioned during that 10-year bond, even though all the interest is collected at the end upon maturity, it has to be recorded ratably over time. And we use the AFR, the applicable federal rate, to determine that amount. So if you have any type of low interest or no interest, you're going to have OID, and you have to calculate that using the applicable federal rate during that specific year, the AFR, applicable federal rate. Okay, and the interest and OID, those are separated from the principal because remember, they are not part of the payment. So interest or OID is recorded as income. It's income in the year. It's actually, so an actual or constructive, right, for the OID receipt. So again, in my example with the zero coupon bond, you pay $50 at the beginning, you get $100 at the end. So you're getting your $50 back that you paid, and you get additional $50 of interest. Well, you have to record that interest as it's constructively received or accrued over the period of time. Okay, so that's how we do it. And again, we use the applicable federal rate. I don't want to go any further because, again, this is meant to be a basic, but you would have to calculate that. And again, if you have zero interest or low interest, you have to worry about that. Now, in our example, we're paying 20% interest, right, over that period of time. So that's going to be quite high. Okay, the applicable federal rate does not get that high. So that's you do a general test, a general way. Okay, this is obviously a lot higher than most interest rates, if you will, especially at the federal rate. That's the idea, but you do have to check. The second thing I want to talk about as an additional issue is Section 1245 recapture, and I'm going to talk about characterization in general. But I want you to know that if you have Section 1245 recapture, let's say we're selling equipment, not a building, and we took depreciation during that period of time and we get an installment agreement that the installment method applies to. Section 1245 recapture trumps the installment method. It trumps the installment method, and you're required to recognize any gain all up front. All gain, all 1245 gain is up front in the initial year. Even if, let's say in year one, let's change the facts. And let's say that instead, in alternative B, there was no payment in year one, and then there was $60 of payment in year two and $60 of payment in year three. Well, if there was any Section 1245 recapture, you would have to recapture all of the Section 1245 portion as ordinary income in year one, even though you didn't get any payment. See that? It's very interesting. Now, you do add the portion of Section 1245 gain, you add that to the adjusted basis in the GPR calculation, in the gross profit calculation. So you add whatever portion you recognize as ordinary income under Section 1245, you add that to the adjusted basis. And that's how we adjust for that. The third thing I want to mention is that installment method is not applicable to certain taxpayers. It's not applicable to certain taxpayers. It's not applicable to dealers, various dealers. It's not applicable when you're selling inventory. And it's not applicable to securities, like stocks and bonds. Okay? It's not applicable to securities like stocks and bonds. That's very important. It does not, this installment method, if you're selling for a gain, you're a dealer, you're selling inventory, or you have securities, right? Stocks, bonds, and whatnot. You cannot use the installment method to defer your gain. Very important. So there's a few things I want to mention that are really advanced topics that you need to look further. There's a few things in here that I'm just giving you a brief summary, like the OID, for example. You need to look further in that if that's an issue that you have to deal with. But I want to focus on some really advanced topics that are way beyond the scope of this basic discussion. And the first thing is contingent payments. What if there's a contingent payment in place? A contingent payment. And what do I mean about contingent payment? Let's say that you sell a business. Let's change this around to a business. And the buyer does a installment agreement, multiple payments over multiple years for two reasons. One, the buyer has, let's say, to get millions of dollars in financing, millions of dollars. The second reason is that the seller is attesting that, okay, this business is going to make a lot of money for the buyer. And the buyer is not sure, not 100% sure. So the buyer basically puts out an earn-out provision, which really means that, okay, the buyer is unsure, doesn't want to risk it, so the buyer is going to pay more money if the business does well over time. This is very, very, very common, especially if a buyer is buying a business or a seller is selling a business. So what might happen is, initially upon selling the business, the buyer pays $1 million. And then in year 2 and year 3, the buyer might pay a minimum of $500,000 in year 2, but might pay up to $2 million if the business has a certain, meets a certain profit point. Same in year 3. So the seller will get $1 million in year 1, could get $500,000 in year 2, or up to $2 million in year 2. Same with year 3. So there's some kind of range. It's a variable. Contingent payment means there's variable. Well, how do you do this tax calculation, especially when you're looking at the seller, when you have variable numbers? That's an excellent question, and it gets really muddy. The law really looks at it from 3 scenarios. The first, and I'm not going to go through the specific application, but I just want to talk about how the 3 scenarios, what they are. The first is that there's a rule if there's a stated maximum selling price. So that's what we had in my example, right? In year 1, it was $1 million. In year 2, it was up to $2 million. In year 3, it was up to $2 million. That is a stated maximum selling price. That's the amount that the seller can get in those additional years. Another possibility, so that's the first type of where there's a rule. What if there's no stated maximum selling price, but there's a fixed payment period? Okay? So if you have a stated maximum selling price, you apply the maximum selling price rule. If you don't have a maximum selling price, but you have a fixed period, right? It's going to happen over 3 years, you apply the fixed period rule. If you don't have a maximum selling price or a fixed period rule, then you're in a really interesting situation that has a very interesting, it's rare, but it does happen, and you have very interesting rules. That's all I'm going to say. It can get very difficult, but contingent payments are very common, especially when you're selling a business, and this is an advanced topic. I'm just, introducing it to you. This is something to look further in if you really want to look more at installment sale. So the second advanced topic I want to talk about is electing out of installment method. And you might be asking yourself or questioning, why would you ever elect out of this, right? Because you're seeing on the screen. Look at the screen. Look at why, as a seller, you would practically never want to elect out of this provision. Remember, installment method only applies when you have a gain. And remember that under the general rule, a seller wants to defer gain as long as possible. Why would you elect out? Because if you elect out, it's not going to defer gain. It's going to actually accelerate gain. Well, I'll just give you a brief summary, but it actually is a lot more advanced because you have to run present value analysis and computations and whatnot and opportunity costs. But there's a few reasons, and it's more about planning. Maybe the seller has some expiring NOLs that they need to use that they can offset, and they'll be gone in the future. Okay, that's an advanced topic. Or maybe the seller, it's possible that the tax rates are going to increase in the future. So that's more of a political scheme, right? If the tax rates go up in the future, then you're going to want to recognize all the gain now when the tax rates are lower. Or maybe as a seller, you're going to be in a higher bracket in the future because this year you had a very low year. It's all sorts of issues. It's an interesting thing, but it is an advanced topic because you really it really depends on the specific seller. But almost always, 99.9999%, the seller wants installment method because, again, it applies to gains and we want to defer gains. So the last thing that we're going to talk about, and then I'm going to talk about the buyer and also mention, we're going to go through an example to apply these rules and how they work to our example, right? Alternative B is characterization. And characterization, when it comes to installment methods just makes tax even more interesting, but also more difficult. And this, as accountants and tax professionals, this is what keeps us in the business and making money and charging rates that are very difficult. Because as you know, being a tax professional, right, anybody can do their taxes, but being a tax professional, there has to be value added. So really what it comes down to is if you're selling one asset, you can classify that character. But what if you have multiple assets? If you have multiple assets that have multiple characterizations, it can get very difficult. It can get very difficult, right? If this building is one character, let's say it's 1231. Okay, well, that's pretty simple. If we have interest, that portion is ordinary, and then we're looking at the principal portion, the recovery of that, using our ratio, that's going to be 1231 gain. Okay, we can do that. Even if we have 1245, same idea. But really, what if you're selling a business where you have a building that, let's say, is 1231, okay? And you have some equipment that is 1245. Okay, we can still deal with that because maybe the equipment is 1231 as well. But what if you have like inventory that's ordinary? Well, when it comes to characterization, when you get these different payments, you're getting payments for a percentage of the business. You can't just say, oh, in year one I'm paying for the business, the building, because I want the 1231 in year one, and then later on I want the ordinary. No, it's a percentage of the entire business. Like I said, remember, we take this approach of the middle ground because we do a rateable portion, because it's as if you're selling a portion, a third, a third, a third of the business, because of the characterization. So what we do is we look at the business, and I strongly recommend, if you're really interested in this, looking at my buying and selling business videos. There's a general video that deals with how we allocate the basket price, the price for multiple assets of a business. We go through an analysis under how we allocate it out. And really it's based on fair market value and a class system. And that's how we allocate, based on liquidity. Well, we do the same thing. We do fair market value allocation, fair market value, relative fair market value. That's what we do when we get a portion. So if there was, let's say, 3 assets, we sold a building, inventory, and some equipment that is section 1245 and is 1231 as well, and the building is 1231. We would have to look at the fair market values of each of those items being sold, and we'd have to calculate the percentage and say, okay, we look at all 3 fair market values, add them up. Let's say the building makes up 40%, the equipment makes up 30%, and the inventory makes up 30%. Well, with that $40 payment, which 33 is considered principal, because remember 40 minus 7 is 33. 33 times 40% would be the building, 33 times 30% would be the equipment, and 33 times 30% would be the inventory, because you use relative fair market value. And from that you subtract away the percentage basis, applying the adjusted basis as well. So this can get very, very, very challenging. It can get tough. You have to do this calculation, this basic formula for each individual asset, because the payment will be that portion of payment and the gross profit ratio will be that portion of each asset. This can get very challenging, and as this is one of my areas, this is one of my focuses. I do this on the side in addition to teaching, and I'll tell you that it can get very muddy, and this is what clients and accounting firms, they actually pay me to come in and look at this. And I think it's very interesting, but it also can be very challenging, okay? So that's very important to understand. So this is all dealing with the seller. Now the buyer is a lot simple. When you're a buyer, you simply just take a full basis in the asset, even though you're paying for this item. So let's say the buyer here is buying the building and it's under alternative B. They're going to pay 40, 40, 40. Well, they get a $100 basis in the building immediately. They would get a $100 basis in the building upon buying in year one initially. So they can start depreciating that building in year one using that $100. It's not, okay, you get 33, 33, and 34 each year. No, you get all of it up front. You get all of it up front. The installment method only applies to the seller. The buyer takes the full basis for the principal amount. You don't get to add in the interest, right? That'd be too good to be true. Only the portion for the principal. Okay, that's important to understand. So again, the buyer, it's simple for the buyer. The seller is the one you got to worry about. If you're studying for the CPA exam and you're studying for maybe a law school course or an accounting course, you're going to get questions about the seller almost never the buyer because the seller has the difficult consequences. Okay, before I conclude this, you might be asking, well, how do we apply it to the seller if the seller picks B? If the seller picks A, right, it's obviously a $40 recognized gain. Let's say it's 1231. So it'll be 40 recognized gain in year 1. But if the seller picks alternative B, well, how do we do this? Well, let's go through our analysis, right? We have a gain. So we have to apply, and we have 2 or more tax years with payments because we have 1, 2, 3 tax years with payments. So our basic formula is the gross profit ratio times the payment in the tax year. So the gross profit ratio in all 3 years is the same. So let's calculate that first, right? So the gross profit is the selling price, which is the total selling price, since again, this is for all the years. So the total selling price, we have 120 total, right, payments. But it does not include the interest. So we do not include the $20 of interest. So it's going to be 120 minus 20, which is 100. So that is the selling price, minus the adjusted basis. The adjusted basis here is 60. So 100 minus 60 is 40. Okay? Now, the contract price is the selling price, which again is 100. It's the same number. We calculate the same. Minus any qualifying indebtedness. Do we have any qualifying indebtedness? No. If we did, we would have to subtract that away for the types of qualifying indebtedness we discussed. So that's going to be over 100. So the gross profit ratio is 40%. So we apply it to year 1 and 2, right? Because the payment is going to be the same. The payment is the principal portion of the payment actually or constructively received, not including interest or OID. So in year 1 and 2, the gross profit ratio, which is going to be the same for years 1 and 2 and 3, is 40% times the payment, which is 40 minus 7, which is 33. So 40% times 33 is $13.20, which we're going to round to $13. We're going to round down to $13. So it's $13 in year 1, $13 in year 2 is recognized gain. 1231 gain because that's the character. In year 3, we do the same thing. Gross profit ratio times payment. Gross profit ratio is 40% times payment. Payment is the principal portion, not including interest, right? So that's going to be 40 minus 6 is 34. So 40% times 34 is $13.60, which we're going to round up to $14. So we have $13 plus $13 year 1, year 2. This is year 3. So this is going to be $26. $26 plus 14. When we add that up, gives us $40 of gain that we recognize total. Again, we recognize $13 of recognized gain in year 1, 1231 gain. $13 in year 2, which is 1231 gain, and then $14 in year 3. So we recognize 13 plus 13 is 26. 26 plus 14 is 40. $40 total. Remember, in year 1, we should have recognized $40 if we did alternative A. So our numbers equal. Now you would recognize the interest each year. $7 of interest is ordinary in year 1. $7 of interest is ordinary in year 2. And $6 of interest is ordinary in year 3. So you'd recognize $20 of interest total over, again, interest is recognized in actual year or constructive year receipt of its OID. So guess what? From the applying this ratio, it equals the same number. The $40 gain is recognized, but again, it's done ratably over time. So this is why, again, we use this approach. It's more economical. So I hope you've enjoyed this video. Again, this is a very fascinating topic. It's a very common topic because a lot of sales of property occur with more than one payment in multiple years. So please make sure you go back and you understand this. And try some examples. Play around with some numbers. Make up your own numbers. Do it with the indebtedness. Try to work it out. Again, though, in the end, it should check out with the same numbers when you're comparing a situation where if you recognize it all in the first year versus over time. Okay, over time. So I hope you've enjoyed this video, and please make sure to watch the other characterization and property transaction videos.